Welcome to the Capital News. I am your host, Alex Karitis. Today is April 17th, 2019. Thank you so much for joining me. I hope everyone out there is doing well today. Let's take a quick look at the markets. The S&P closed down about 7 points. The Dow was down 3 points. The NASDAQ closed down 4 points. And the Russell 2000, the small cap index, closed down 15 points, very close to a 1 percentage point decline for the day in regards to the small cap. We're going to come back and have a brief conversation on what that might mean. Oil now sits at $63.66, so right around, again, that $64. I believe Brent is trading a little north of $70 a barrel, so look out, consumer. You're paying more at the pump. You already know this. Gold now sits at $1,274, so quite a bit away from our $1,300 benchmark that we're looking at. Silver also remains under $15 and now sits at $14.90. The U.S. 10-year Treasury had no movement. It still sits at 2.592%. And the VIX, the volatility index, increased 3.5 percentage points today and now sits at $12.60. Now, going back to the Russell 2000, the small cap index being down about 1 percentage point for the day. Why do I call attention to this? Well, again, if you've been following this podcast, I call attention anytime there is a market close either up 1 percentage points or higher, or if it closes down 1% or lower. Okay, this is going to the story of volatility. Again, this is my model. When I look at my model and I see these more days of these types of swings, up 1%, down 1% or more, it's calling into question what's going on. It's, again, a piece of the puzzle. It's not the whole picture, but to me, it's an important piece. 2017, 2018, we saw very low volatility, particularly in 2017. 2018, obviously, in the fourth quarter, we saw a major pickup in volatility with the sell-off of 10% and then 20% in most equities, if not more. So we saw an increase in volatility. And the way that I was analyzing that last year was this is the calm before the storm. Doesn't mean that it's imminent. Doesn't mean it's happening tomorrow. Same thing with having very low unemployment, which we do. Same thing with having a yield curve. These are usually triggers that there is going to be some sort of slowdown, if not an outright recession, coming our way. Again, it's not imminent, but it's a signal. It's an important piece of the economic puzzle. So I know last week I think there was 2 consecutive days of 1 percentage point moves in regards to the Russell 2000. It was down 1%, and the next day it was up 1%. That may very well happen tomorrow. But I want to get this in your guys' head to pay attention to this stuff because, to me, I find it to be important. Now, why this is a little bit more interesting now is because we're more so in the fuller swing of things when it comes to earnings season for the first quarter of 2019. And when you look at the small cap index, I want to draw particular attention to these guys because they are still in a quote-unquote correction territory. They have not rallied as strongly as have the larger cap companies. In the S&P 500, a lot of the NASDAQ, and obviously the Dow is comprised of 30 companies. So that's why you've seen huge gains there. You've also seen huge gains in the Russell 2000, but they're still technically in correction territory, which means they're still 10% below their all-time high, okay? Will it rally? It could. Will it reverse? It could. Will it consolidate and stay in a range? It could, okay? Your guess is as good as mine. We're in the financial world of Oz. But the fact that we are seeing this increased volatility in the small cap index over these past couple weeks is telling to me, and this is no surprise to me, again, given my volatility model that I like to look at, okay? So what's interesting here with the small cap index relative to the bigger players, all right, the big boys. Small cap is basically has almost 100% of their business is conducted here in the United States of America, okay? So if everything is going fantastically well, which we're constantly told that it is, then the Russell 2000 shouldn't still be in correction territory, right? If everything is going fantastic, all cylinders going, full speed ahead, why is the Russell 2000 still teetering here? Again, that could change. That could change. But now with more and more information coming out, we've been looking at the earnings, we've been looking at the revenue, we're starting to see some concern there. And I'm going to read an article to you guys that talks about this because it's very timely, and I think you're going to enjoy it. But this just goes to the broader picture of which we're being told, and then you look at the data, and they don't paint the same picture. If everything was rosy here in the United States, then the small cap index should be booming. It shouldn't still be in correction territory. This is, again, going to the risk on, risk off trade, all right? Smaller cap stocks, riskier than your blue chip companies, all right? That's common sense. We know that. But are the small caps telling us something? Is this something that we have to start paying attention to? Because this was part of my thesis going back last year and why I got out of the markets. Again, not entirely, but I put a lot of my portfolio into cash because I just didn't have, I had a feeling that things weren't right. Something was wrong. I really started to believe in diminishing marginal returns when it comes to money printing and quantitative easing and lower interest rates and all that jazz. And I just said, you know what? We've ridden this wave for 10 years, basically. Let's not be overly greedy here. Let's take some profits. Let's take some money off the table, and let's just park it into cash and see what happens. All right? Well, I'm very glad I did. I'm very glad I did. I still have money that is long in this market, so I still took, place in this recent V-shaped recovery rally that we've been witnessing here for the past few months. But it was just time to get into cash. All right? But at the time, it was my thesis that especially get out of the small caps, maybe even short the small caps, that type of thing. And that turned out to be a good play. Everybody was saying, well, no, you don't got to worry about that. The small caps were the safe haven. That was what everybody was saying. You don't have to worry about the small caps in regards to the U.S.-China trade war that's going on. That just has to deal with the big boys, yada, yada, yada. What you have to understand is small caps support a lot of the big boys. They're their suppliers. They're their vendors. They do a lot of business with them. So it becomes a downstream effect. In addition, now you're starting to see a lot of pundits and analysts on Bloomberg and Fox Business and CNBC come out and say, well, the small cap, if this does turn down, it's not going to be good for them. Why? Because they have a lot of debt, which we talk about here constantly. They have a lot of debt. And if you have a severe contraction, guess who's going to get bailed out? It ain't going to be the small cap. It ain't going to be the little guys. It's going to be the big boys again. It's going to be the Exxon Mobils. It's going to be the Chevrons. It's going to be the JP Morgans. It's going to be the big boys who get bailed out, not these little guys, okay? And if the banks even have money to lend out, who do you think they're going to give it to? They're going to give it to the Exxons of the world. They're going to give it to the Walmarts of the world. They're not going to give it to some small cap company. They're just not going to do it. They don't have the cash flow. They don't have the business. They're just not going to do it. So the small caps are in a stage right now where they could just get decimated. They got decimated in the fourth quarter of 2018. I don't see any reason why it couldn't happen again. They're debt-ridden. They're not going to be bailed out by the government. They're not going to be bailed out by the banks, because if you have that type of event occur, the banks are going to hoard cash, or they're only going to give it to the biggest companies out there. So, again, does this mean that the Russell 2000 is going to roll over tomorrow? No, it does not. We live in a financial world of Oz. We see it every single day. A tweet, a stupid headline comes out, and these markets could rally. Makes no difference what the fundamentals of the market are. If it's something that these markets can cling to, if it's hope, they're going to ride it as far as they can. But just keep this in the back of your minds to pay attention to the Russell 2000 and what's going on with the small cap index, because it's going to be very telling as to what's going on in the U.S. marketplace. Because when you look at the Dow, when you look at the S&P 500, a lot of these companies generate their revenues overseas. So they're more geographically diversified. All right? So yeah, you could see, well, maybe things are okay somewhere else, and therefore some of these companies in the S&P or in the Dow are doing just fine. Okay? You can at least make that argument. When it comes to the small cap, you're really relying on the resilience and the growth of the United States, which we know is slowing. Okay? So no surprise there. Now, moving on to this article that I want to read to you guys. This comes from Bridgewater Associates. And again, this is the largest hedge fund in the world, $160 billion in assets under management. And this is founded by and managed by Ray Dalio. the same Ray Dalio we've been talking about here the past few podcasts, especially in relation to his recent article that says capitalism needs to be reformed. And we responded to that and we said, no, capitalism does not need to be reformed. It needs to be reinstated. So here is a report that they issued, and there was an article written on it that just came out today. So let me read this to you because I think you're going to find it interesting. It's very timely, and it's what we've been discussing here for quite a while. Bridgewater warns of peak U.S. profit margins, lower stock prices. The major drivers of U.S. corporate profit margins are unsustainable and now under threat, which will eventually result in much lower equity prices, Bridgewater Associates, the world's largest hedge fund, said on Wednesday in a report. Over the last 2 decades, U.S. corporate profit margins have surged and have contributed more than half of the excess return of equities relative to cash. Without that consistent expansion of margins, U.S. equities would be 40% lower than they are today. This is no surprise to us. That 40% lower number is exactly where I've been telling you guys it's likely to head at the minimum. And that just takes you back to 2016. Look at some of the prices in 2016, and that gets you back to 40% decline. That's what we've been talking about here. Is Ray Dalio and company listening to the Capital News? I hope they are. If you're listening, Mr. Dalio and company, capitalism does not need reformed. It needs reinstated. Better yet, hire me and pay me 7 figures. I'd be glad to help. Let me continue. Over the last few decades, almost every major driver of profit margins has improved. Labor's bargaining power fell. Corporate taxes fell. Tariffs fell. Globalization increased. Technology allowed for greater scale and lower marginal cost. Antitrust enforcement fell, and interest rates fell. These factors have produced the most pro-corporate environment in history. Many of these drivers of high profit margins are now under threat. Some of the forces that supported margins over the last 20 years are unlikely to provide a continued boost. Incentives for offshore production have been reduced as global labor costs have moved closer to equilibrium, with domestic costs and rising trade conflict increasing the risk of offshoring, while the potential tax rate arbitrage from moving abroad is now much smaller. At the same time, popular sentiment has begun to turn against the forces driving corporate profits, as well as against the companies that have benefited the most. We are in the midst of a populist backlash against rising inequality and increasingly seeing a move towards more protectionism. Recent surveys show increasing animosity towards globalization and the power of companies more broadly, and a bit more welcoming attitudes toward government regulation of firms. There is also more discussion about taxing mega profitable firms that have benefited from current government policies. For example, Europe's potential digital services tax is explicitly designed to close the tax arbitrage by introducing a sales tax on online revenues from residents. While the current impact of these proposed rules on the overall profitability of these tech giants is relatively small, they are a straw in the wind that the tide might be turning, and that the multi-decade boost from favorable taxation policies is unlikely to be repeated, Bridgewater said. Well, there you have it, folks. Signed, sealed, delivered from the world's largest hedge fund. Stuff that the Capital News has been telling you for the past 3 months. No surprise if you've been paying attention. But now you have the world's largest hedge fund giving everybody a warning. What's going on here? This is exactly what we've been saying. Bridgewater warns of peak U.S. profit margins, lower stock prices. And again, they're predicting potentially 40%, much, much lower stock prices. Again, all hell broke loose Q4 of 2018 when they went down 10% and then they went down 20% and everybody thought it was the end of the world. And no, the Federal Reserve, we made a mistake. We didn't mean to do this. We didn't mean to do that. President Trump comes out and tweets, buy the dip, didn't tell you to sell short, didn't tell you to get out of the market, sends his Treasury Secretary out to the plunge protection team, and then you've had a V-shaped recovery ever since. You've only seen V-shaped recoveries, especially of this magnitude, only a few times in the course of history. Okay? This is a bought and paid for. This is a fixed market. Ain't no doubt about it. Investigate that if you want to investigate something. This is disgusting. It's despicable. This is where we are. And this is all because the president wants to take ownership of this phony economy and this bloated, bubbly stock market. So he's trying to save his hide. And he was able to for a few months. And now, again, he's trying to box himself or dance himself out of the box he's placed himself in, wants to blame the Federal Reserve and do a whole host of other things. We'll see where that gets him. But more importantly, we have to listen to people like Ray Dalio, I think, because they're in the know. This guy has everybody's phone number, okay? Bridgewater consults governments and central banks and has conversations with these people, all right? They know what's going on, and you have to give credit to Ray Dalio and company at Bridgewater Associates because these guys are like the masters. They're the king of diversification, all right? They have everything. They got your stocks, they got your bonds, they got your real estate, they got your commodities, you have your precious metals, all right? They do it all, and they come out ahead almost every single year, all right? So kudos to them and their team. But this is stuff that we have known here at the Capital News. There's no question in my mind that Bridgewater Associates knew this for quite a while too. Because if you follow Ray Dalio and some of these other big market movers and managers out there, last year Ray Dalio in a lot of his interviews was saying, you know what, I think we're probably in the 7th, maybe the 8th inning of this business cycle, of this bull market, of this credit cycle. 7th or 8th inning. Okay? This year, he's still sort of in that same boat. 7th, 8th inning, more towards the 8th inning. Okay, so at least we're moving in that direction, right? We're going up, closer to the 9th inning. All right. Now, this isn't baseball, so there's no guarantee that there are 9 innings in a business cycle or anything like that. And of course, a baseball game can go into extra innings. So we're not saying that's the end all, but at least you have a reference point, okay? Mr. Dalio and company obviously changed their mind in some of their models a little bit and looked and said, well, you know what, with the Trump tax cuts that took place and with the Federal Reserve basically doing a 180, well, maybe this can go on a little bit longer. That's reasonable, that's rational. We talk about that here all the time. When this is what fixed the market, okay? The Trump tax cuts, that was a boost to a lot of individuals in your take-home pay, and it was definitely a boost to corporate America, all right? But the government did not cut spending, so you had deficits exploding at the expense of that, which is not good for anybody, all right? But it makes GDP look better, which is what the White House wants to happen. So again, it's just fixing the numbers, making things look good. You just have to understand how everything's calculated. But now, all of a sudden, in the midst of Q1 earnings, you have a report that comes out from Bridgewater Associates saying that everything that has been supportive of stock prices for the past few decades is now starting to unwind and come to an end, and they are anticipating much lower equity prices, as much as 40%. And again, that takes you right back to 2016. Easily 2016. Again, take your time, go online, just go to Yahoo Finance, look at a stock chart of the S&P 500, a chart of the Dow, a chart of the NASDAQ, even a chart of the Russell 2000. Go on Yahoo Finance, click on that little picture that pops up right on there, and then click on Max, and it'll give you a Max chart going back probably 20, 30 years, if not longer. It's growth at an exponential rate. At an exponential rate. It is not sustainable. This is all funny money. This goes back to our previous podcast when I said we were taking a look at the monetary base, which basically gave us a picture of the effects of quantitative easing, and we indexed that again and overlaid that against the Wilshire 5000, which is the total stock market. No surprise, folks, that this rally for the past 10 years has been bought for by the Federal Reserve and paid for by everyday Americans. Again, the largest wealth transfer in the history of the world. Went from the lower class, the middle class, all the way up to the top 10%, the top 1%. All right? That is what happened. Again, we don't demonize profits, we demonize fraud, and we have been living in fraud for a very, very long time. This house of cards will come crumbling down. unfortunately, once again, but that's what we have to deal with. We have to deal with. Take a look at my recent article on the capitalnews.com in regards to why do we fear recessions? I mean, these are corrections. If something is being corrected, it is for the better. Now, there's going to be a lot of pain, and I understand that's why people generally will fear it, especially of what I am imagining is going to be quite severe. And now it's actually interesting because, again, if you pay attention to Ray Dalio, him and some other managers of that firm have come out and said, well, you know what, we don't anticipate something severe or drastic, but we see something taking place over a very prolonged period, basically 10 to 20 years is what they're saying of slowdown, of a slower growth period in time within the United States. That's a long time, folks. I happen to agree with that, by the way, and that has a lot to do with, again, the demographic cliff that we are facing, where you have more and more people retiring or at least reaching retirement age and people living longer. This is going to have the effects of this I can't even fully address to you in the time we have left today. But it's something that we're going to continuously talk about on this show because it's going to be very, very important. So even if somehow we skate by this correction that I believe is coming, even if somehow we say, for the sake of argument, we skate by it, we are not going to dodge the demographic cliff because we can't. You can't make a 60-year-old 40 years old again. You just can't do it. All right? You can print money like it's going out of style at the drop of a hat, but you can't make a 60-year-old or a 70-year-old 40 years old again. So that has huge implications, huge ramifications and negative consequences for our entitlement system, our deficits, our national debt, the whole kit and caboodle. All right? So it's very interesting that we have this coming out from Bridgewater, again, warning of peak U.S. profit margins in the midst of the 8th or 9th inning of a business cycle, of a credit cycle, where margins are getting squeezed and where you have debt past the eyeballs. Where's the money going to come from to pay for all this? Well, people are going to get laid off, and then you're going to see a ripple effect, a domino effect. What's going to be the first catalyst is anybody's guess. But we have so many dominoes set up, it ain't even funny, and it ain't going to be pretty. But let's stay tuned on this. I'll keep you up to date on anything else that comes out. But this is so very important and so timely. And I'm so happy to hear this, that it sort of vindicates the Capital News that we have the world's largest hedge fund coming out and saying what we've been talking about for the past few months. So stay tuned. We know what we're talking about. Please like, share, subscribe, get the word out. Leave your comments. I would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.